So let's actually get started with the first company that I want to cover, and that is none other than Bank of America. So Bank of America did have earnings today, and it was just absolute insanity. I mean, let's bring up, oh yeah, also here's something too, guys. Let me just bring this up really quickly. For some reason, I cannot use Seeking Alpha right now. I don't know why, but I can't use Seeking Alpha because every single time I click on the company, this happens. So I have no idea what in the world I'm supposed to do with this. I don't know how to get rid of it. It just looks awful when making a video. So I am so terribly sorry, but you know, it is what it is. I'm gonna have to use Market Watch in order for this. Now, when it comes to Bank of America, here it is. Bank of America GAAP EPS of $1.80, not $1.88. Bank of America GAAP EPS of 88 cents beats by 5 cents. Revenue of $25.2 billion beats by $260 million. So right off the bat, this is already looking insane. Now, we can see here that they do have a couple. Let's jump into this. We got Bank of America reports Q2 of 2023 net income of $7.4 billion, EPS of 88 cents, as we saw, up a whopping 21% year over year. Revenue grew 11%, led by 14% improvement in net interest income to $14.2 billion. 8th consecutive quarter of operating leverage, CET1 ratio of 11.6%. So that's a massive beat. Like, straight up, not gonna lie, that's a massive beat. So what are we gonna look at this? When it comes into the highlights, we can see net income rose 19% to $7.4 billion or 88 cents per diluted share. Revenue, net interest of expenses grew 11%. We already saw this. Net interest income up $1.7 billion or 14%. to $14.2 billion, driven primarily by benefit from higher interest rates and loan growth. Once again, we saw this exact same thing when we read JP Morgan's as well, right? Loan growth is by far one of the biggest catalysts for this net interest income actually increasing. Non-interest income of $11 billion increased by $795 million or 8%. Provisions for credit losses of $1.1 billion increased $602 million. Net reserve build of $256 million versus net reserve release of $48 million in Q2 of 2022. Let's take a look at now over here when it comes to like the dividends as well as the book value per share, because that's a little bit important right there, right? That's a little bit important. Now, when it comes into the it's funny. So common equity tier, so CET1 ratio of 11.6 increased by 23 basis points. Returned $2.3 billion to shareholders through common stock, dividends, and share repurchases. We're going to take a look at that as well. Again, Market Watch, we really can't take a look at this on Seeking Alpha right now for whatever reason. I don't know. They're being stupid right now. Book value per common share rose 7% to $32.05, which again, we are going to take a look at that when we take a look at the calculator, right? We got to take a look at the tangible book value and book value as a ratio for the price. And then the tangible book value rose by a whopping 10% to $23.23. Wow, this is absolute insanity. $23.23, guys. Return on average common shareholders equity ratio of 11.2. Return on average tangible common shareholders equity ratio of 15.5%. Wow, absolute insanity. And here they have it through the segment. We can see here that consumer banking net income was $2.9 billion. And when it comes into the global health and investment management, net income was $978 million. So yeah, consumer banking was by far the biggest one right there. Global banking, wow. Global banking net income of $2.7 billion and global markets at $1.1 billion. So overall, guys, consumer banking makes a majority of their net income, which is not surprising in the slightest, right? It's not surprising in the slightest, especially since, when SVB collapsed, right? When SVB collapsed and FRC collapsed, most of the people went to what? JP Morgan, Bank of America, because of security, the fact that they are major banks. So not surprising that consumer banking was their biggest form when it comes to their net income. Now, let's take a look at what the CEO had to say. Quote, "We delivered one of the strongest quarters in the first half net income periods in the company's history. Continued organic client growth and client activity across our businesses complemented beneficial impacts of higher interest rates and produced an 11% increase in revenue. We continue to see a healthy U.S. economy, that is growing at a slower pace. Notice how that strictly contradicts. I really wish Mike was here. Notice how that strictly contradicts what Citi was saying, right? Citi was saying the complete opposite. Yet these guys are saying pretty much something similar to that of JP Morgan, where we continue to see a healthy U.S. economy that is growing at a slower pace with a resilient job market. That's not what the Fed wants to hear, right? That's not what the Fed wants to hear at all. If you all know, the Fed wants to crash these markets. The Fed really, really do. Or at least they want to crash the job market specifically. Continue to say, all businesses performed well and saw improved market share, particularly in our sales and trading and investment banking businesses. A strong balance sheet and ample liquidity allow us to continue investments in our franchise to drive long-term value for stakeholders. So all of that is good and dandy. If we come over here, we can see a couple graphs. Actually, didn't even. Let's actually see what this is about. It didn't even. Okay, so this is the net income quarter over quarter. All right, cool. And this is the common equity tier 1 capital. That's the red graphs are the tier 1 capital, and then the dash are the capital ratios. All right, let's take a look at this on the 3-month ended, because I'm very, very curious. So we got over here total revenue net of interest expenses. We got is this Q1 or is this? Okay, I see. Okay, I see. Yeah, so this is Q1 of 2023 was 26.3 billion. I'm pretty sure this is in billion. 26.3 billion. And Q2 actually came down, guys, going from 26.3 down to 25.2. So that went down. Huh, that's interesting. Year over year, though, the revenue did go from 22.7 up to $25.2 billion. When it comes into the net income, we can see another downturn on the quarter, 8.2 down to 7.4, but year over year, 6.2 to 7.4. All right, so that kind of, I don't know. The quarter over quarter number isn't really too much of a big deal. The year over year one's a much bigger deal, especially for me. But still, it's a little bit concerning nonetheless. All right, so with that said, let's jump into the calculator. Let's see if their fundamentals are any good from a 5-year perspective. We got the ticker of BAC, market cap of $244.65 billion, and current PE of 9.26. All right, 9.26 with a current share price of $30.70. Now, unfortunately, again, I can't go to Seeking Alpha and do this, guys. I really can't, because this is just in the way. I have no idea how to get rid of it. So we're going to take a look at none other than, if I could find it, we're going to take a look at, guys, Market Watch, because it's fairly similar, right? It's fairly similar. We got, well, guys, take a look at this. On the, can I change this to, okay, whatever. I'll just take a look at this. Look at this, guys. On the 1 day, so just today trading, this thing gained roughly 4.42%. Absolute insanity. Then again, they did beat earnings by a significant amount. So, yeah, that's not... I don't know how I feel about this, man, because this company, if we take a look at this on, let's just say the 6-month ended, you can see that this thing went as low as, on a dollar perspective, this thing went as low as like $26. In fact, if we come over here, the 52-week range is 26.32 to 38.60. So we're pretty much smack in the middle between these two numbers. And again, around $30.68. Now, coming back into the calculator, we can see that they do pay out a dividend of 88 cents per share. This is annual. And unfortunately, well, I don't know if I should do it like this. Again, I'm just so used to Seeking Alpha. All right, well, I guess we'll do it. This is a yield, guys, of 2.99 and a payout ratio of 26.13, a 5-year CAGR of 13, almost 13, with 9 consecutive years of dividend payment. Now, really, I'm wondering if this actually shows that. It shows the yield. It does show the yield, but it doesn't show the. Okay, so it doesn't show the overall payout ratio. So they do show the yield, and we can see here that the ex-dividend date passed as of June 1st. And the payout date, they don't even show the payout date. I'm so used to Seeking Alpha. Oh, man, I am just so sorry. I am so sorry, everybody. Again, it's not really my fault. Seeking Alpha just sucks right now. I don't know why. Nonetheless, though, payout date, it is, let's come back over here. The payout date was on, June 30th, and they pay their dividends quarterly. All right. Let's come back into the calculator, and now that's messing up too. Wow. Okay. So based off the current shares outstanding, based off of this 88 cents in annual dividends per share, we got that they pay out $7 billion in dividends every single year. Now let's jump into the fundamentals. Now, when it comes to the net income, we got 5 years ago of $28.14 billion to today of 28.6. Now that is an increase of 1.69%. Tiny increase. You can see here that they did come down 3 years ago and then up again 2 years ago. And then they pretty much came to the median as it was by 5 and 4 years ago. So overall, I have no, to be fair, they are doing really, really good right now. But you saw that quarter over quarter is coming down. Nonetheless, though, I think I'm going to give this, I would say, around like a 60% or so. Looking now into the total revenue. Total revenue is looking a lot better. 5 years ago of 87.7 billion to today of 94.5 billion. That is an increase of 8%. Once again, the drop during COVID, it did come up during 2 years ago, as pretty much all of these companies actually do that. And, well, after that, they came down a little bit, but then they're growing so, well, actually, so far this year, they're really doing really good, 94.5 billion. So that's really, really solid overall. I think that they'll exceed, I think that they'll continue to increase this. Again, we still have half the year left. So I think I'm going to put this, guys, I would say at around like, let's just say at around like an 80%. It's looking really, really good overall. Shares outstanding, by far, I mean, pretty much all of these big banks, they have pretty much the same common shares outstanding trend, which is decreasing. And you can see here, we got 9.7 billion shares to today of 7.97 billion shares. That's a decrease of 17.55%. And from the previous year to the current year, there's another decrease of 0.31%. Really nice, consistent decrease. There isn't a single time when this thing is actually increased. So I'm going to give this, guys, a 100%. Looking now into the assets minus the liabilities. Aside from the 3 year ago value, which the following year, so from 3 to 2 years ago, it did fall by around $2 billion or so. It's not looking too bad. They did recover as of 1 year ago, and today they're even higher than that. So I'm actually liking this assets minus liabilities. Average total assets, it is 2.84 trillion. Average liabilities is 2.56 trillion. Doing this difference, we get $271.1 billion. I have to give this, guys, a 100%. Looking really, really good. And with that said, well, we can now take a look at the overall grades. And if you come over here, well, Bank of America is an 82. Again, not really surprising. It's a major bank. It's, you know, shares outstanding is great. Asset management liability is great. The only bad one is that of the net income. And honestly, it's not even too bad. It's just I have no idea where necessarily this is going. Nonetheless, though, you can see that 82% is a pass. However, what price do we pay for this company, especially after the meteoric rise it had today of a whopping 4%? Well, the fact of the matter is that if we take a look at the book value per share, come down over here, you can see that the book value currently it is $31.58. Now, if we take a look at the, let's see over here at the earnings, we can see that they do revise this, so $32.05 and then $23.23 for the tangible one. So right then and there, this is already looking like a whole lot more. Let's actually do that. Let's actually make that exactly 32.05 and then 23.23. So let's make this 32.05. Let's make this 32.05. Perfect. And yeah, guys, I mean, it's a great looking book value. And then when it comes to the tangible book value, it's looking the same. And this is now $23.23. Now, if we take a look at this price divided by this current tangible book value and just normal book value, we can see that, yeah, based on the book value, this is looking really good. 0.96. Again, 1 is considered valuable. Like, one's considered at value. Under 1 is undervalued. Over 1 is overvalued. So, with the 0.96 on the book value perspective, it's looking really, really good. Now, when it comes into the tangible one, you can see that it is a little bit more pricey, but I don't know. I guess the truth is somewhere in the middle, right? The truth is somewhere in the middle. And again, you did have a decent opportunity to buy this company sub $30. So, yeah, that's the book value when it comes to this. I personally think it's a good buy right now. I don't know. When it comes to banks, again, very, very difficult to understand. It's a business that is just, it's iffy, man. It's really, really iffy. So you're better off with these big banks, but understand that, you know, with the Fed still increasing interest rates, we'll see how that keeps going. But with the Fed still increasing interest rates, who knows what could happen? Who knows what could happen? So let's come now into the overall dividends at the current share price. Now, I'm actually going to come over here just so that way you guys can see it a little bit better. I'm going to come over here so that way. Okay, so let's put this at 88 cents. So putting in $5,725, this nets you $164.11. Not a lot, but I guess it's I don't know, it's a bank that has it's a lot of prospects, right? It's the second biggest bank in the United States, so do with that information as you will. Now, that pretty much does it when it comes to Bank of America. Again, sorry, Mike isn't here. He was busy at work. So I think that will pretty much do it for Bank of America, guys.